Welcome to the Deep Dive, your shortcut to cutting through the noise and getting straight to the insights. Today we're taking a plunge into a corner of personal finance and taxation that trips up a lot of people. It's the difference between realized and recognized gains and losses. If you've ever wondered why some financial moves seem to just vanish tax-wise, while others definitely hit your tax bill, well, this deep dive is for you. We're going to try and demystify these terms, help you understand what really impacts your gross income, and why some losses are deductible and others just aren't. Now, before we dive deeper, just a quick reminder. This deep dive is built on material from Farhat lectures. All the examples, the explanations we'll be talking about, they're rooted in the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe studying for the CPA exam, or just a curious professional, definitely check out their website. You'll find extra practice questions, video lectures, detailed support, loads of stuff to reinforce today's topic. And a big thanks to Professor Farhat for providing this valuable material.
That's right. And this distinction, realize versus recognize, it's not just, textbook stuff. It's really fundamental if you're navigating your personal finances, especially when property is involved. Think about your car or maybe investment stocks, bonds. Understanding this difference is absolutely key. It tells you what actually moves the needle on your tax return, what impacts your gross income, why you can deduct some losses, maybe, and not others. It's crucial.
Okay, let's kick things off with what sounds like the simple part, realized gain or loss. When I hear realized, I think, okay, I sold something, made money or lost money. But I suspect it's not quite that simple in the tax world, is it? What are some common misunderstandings there? How do we actually figure out what's realized?
Yeah, you're hitting on a key point. People often think if a transaction happened, it's realized, end of story, maybe taxable. But a realized gain or loss is really just the actual economic result of selling or exchanging property. It's the what happened part, purely financial. Sold it for more than you acquired it for. That's a realized gain, less realized loss. Simple as that initially. The calculation itself is pretty straightforward once you have the pieces. You take the consideration received. Now, that's usually cash, but it could be the fair market value of other assets you got in return. And from that, you subtract the property adjusted basis.
The adjusted basis. That's like your investment in it for tax purposes.
Exactly. It usually starts with what you paid, your original cost, but then it gets adjusted, maybe down for depreciation you've claimed over the years, perhaps if it's a business asset, or maybe adjusted up if you made significant improvements that added value. So you compare what you got versus that adjusted investment. That difference, that's your realized gain or loss. It's always the first step, just the raw economic outcome.
Okay, got it. So we figured out what happened financially. That's our realized gain or loss. But here's where it gets interesting for our tax bill, right?
Yeah.
Because not everything that happens actually counts for the IRS. This is where recognize comes in. What's the fundamental difference there, and why is that the term we really need to watch?
Right. This is the crucial part for taxes. A recognized gain or loss. That's the amount that actually gets included in your gross income, the taxable amount. Or if it's a loss, it's the amount you can actually deduct from your gross income. And here's the key thing. Not all realized gains are recognized. It's not automatic.
Okay. So you could realize a gain but not have to recognize it immediately or ever.
Precisely. Some gains might be deferred, pushed off to a later tax year. Sometimes they might not be taxable at all due to specific rules. And it's the same story for losses. You might realize a loss, feel the financial sting, but find out it's simply not deductible on your tax return. Why the difference? Well, the government has reasons. Sometimes it's about encouraging certain behaviors, like reinvesting proceeds. Other times, it's about preventing what they see as potential abuse, like deducting losses on things you just used personally. So recognized is all about how much of that realized gain or loss actually impacts your tax liability for the year.
Makes sense. So when we talk about individuals dealing with these capital gains and losses, what kinds of assets are typically involved?
Good question. For individuals, we're primarily talking about the sale of capital assets. And these generally fall into two main buckets, things most people own. First, you've got your personal use assets. Think everyday stuff, the chair you're sitting on, maybe your personal car, assuming you don't use it for business, furniture at home, your personal cell phone, things for personal enjoyment.
Okay, the stuff we just own and use.
Exactly. Then the second big category is assets held for investment purposes. And the classic examples here are stocks and bonds, things you buy hoping they'll appreciate or generate income.
Right. And when these gains or losses happen, how do they actually pop up on our tax forms? Is it super complicated, or does it funnel down somewhere?
Well, it can feel a bit like navigating a maze sometimes, but there's a system. Generally, you calculate the capital gains and losses first, often on a separate form like Schedule D. Then the summary usually flows onto Schedule 1, which is attached to your main tax return. It gathers up various types of additional income or loss. Now, if you're dealing with business property sales, you might encounter Form 4797, which is a bit more complex. We won't dive deep into that today.
Okay, so Schedule D, then Schedule 1.
Right. And the key thing for most individual investors is that these gains and losses get netted, sort of combined together following specific rules. And that final netted number eventually makes its way onto your main Form 1040, usually affecting a line item like other income. It all boils down to one number impacting your total taxable income.
Let's dig into those personal use assets. This is interesting because it affects almost everyone. Let's say I sell my personal car. Maybe used car prices are crazy, and I actually sell it for more than I paid. Is that gain taxable? What happens then?
Yes, absolutely. That's a key rule to remember. If you sell a personal use asset like your car, furniture, whatever, and you realize a gain, that gain is recognized. It's taxable income. So in your example, selling the car for more than you paid, that profit gets added to your income for the year.
Okay, so gains are taxed. But what about the flip side? What if I sell my old couch or that car for less than I paid, which is probably more common? Can I deduct that loss?
And here's the kicker. If you sell a personal use asset at a loss, that loss is not deductible.
Not at all.
Generally, no. The government's reasoning here is pretty practical, really. They don't want people deducting losses on items they essentially consume through personal use. Imagine if you could get a tax break every time you sold an old appliance or worn-out furniture for less than you bought it.
Yeah, I see. It would basically be subsidizing personal spending.
Exactly. It prevents deductions for what amounts to personal consumption. So for personal use assets, gains are taxable, but losses, usually not deductible.
Okay, that's clear. Now, shifting gears to investment assets, stocks, bonds, things like that. We always hear short-term versus long-term. What's that distinction about, and why is it such a big deal for taxes?
That holding period is critical for how much tax you'll pay on investment gains. Short-term capital gains and losses come from assets you've held for 12 months or less, 1 year or less. And the really important part, a short-term capital gain is treated just like ordinary income.
Meaning it's taxed at my regular income tax rate, like my salary.
Precisely. It gets added to your other income and taxed at whatever your highest marginal tax bracket is. No special treatment there. But long-term capital gains and losses, these are from assets you've held for more than 12 months, longer than a year. And this is where the tax code offers a significant advantage. Long-term capital gains get preferential tax rates.
Lower rates, right?
Generally, yes. Much lower for most people. Depending on your overall taxable income and filing status, the rate could be 0%, 15%, or 20%. There are also some special, slightly higher rates for certain things like collectibles, which might be taxed at 28%, or certain real estate depreciation recapture tax at 25%. But for typical stock gains, those 0%, 15%, or 20% rates are usually much better than your ordinary income rates. That's why holding investments for over a year can make a big tax difference. Just keep in mind, these rates can and do change over time with tax laws.
Okay. Preferential rates for long-term gains. But what if my investments don't do well? What about capital losses from stocks and bonds? Can I deduct those if things take a hit?
Yes, and this is often a bit of good news for investors dealing with losses. Unlike personal use asset losses, you can deduct capital losses from investment assets. There's a limit, though. You're allowed to deduct up to $3,000 of net capital losses against your ordinary income each year.
$3,000 per year?
$3,000 of the net loss. So after you've netted all your investment gains and losses together for the year, if you still have an overall loss, you can use up to $3,000 of it to directly reduce your taxable ordinary income.
Then what if my net loss is, say, $10,000? I deduct $3,000. What happens to the other $7,000? Is it just lost?
No, that's the other piece of good news. Any excess losses, the amount over that $3,000 limit, aren't lost. They can be carried forward indefinitely to future tax years.
Indefinitely. Wow.
Yep. And they keep their original character whether they were short-term or long-term losses. This is really valuable because in future years, you can use those carried forward losses to first offset any capital gains you might have. And if you still have losses left over after offsetting gains, you can again deduct up to $3,000 against ordinary income in that future year. It's a key tax planning tool for investors.
Let's try to make this really concrete with a couple of examples. First, let's talk about Ella. She sold 2 vehicles, one used for business, one personal. How does that play out?
Right. Ella's situation is a great illustration of how asset type matters hugely. Her first vehicle was a delivery van. She used it in her fast food business for 4 years, then sold it at a $2,000 loss. Now, because this was a business asset used for business and held over a year, its sale falls under specific rules, often called Section 1231 rules. This $2,000 loss is typically treated as an ordinary loss, not a capital loss.
And ordinary losses are generally better, right?
Mhm.
Because they're fully deductible against other income.
Often, yes. Unlike the $3,000 limit on net capital losses against ordinary income, ordinary business losses can often be fully deducted, which is a significant benefit. So that $2,000 loss from the van likely reduces her business income directly. Now, her second vehicle was her personal car. She used it just for herself for 2 years and sold it at a gain. As we discussed, since it's a personal use asset sold at a gain, that gain is recognized and taxable. And because she held it for 2 years, more than 12 months, it's a long-term capital gain.
So he gets those lower tax rates, 0%, 15%, or 20%.
Exactly, depending on her overall income level. But here's the crucial point. She absolutely cannot use the $2,000 ordinary loss from the business van to offset the capital gain from her personal car.
Because they're treated completely differently under the tax code, apples and oranges.
Precisely. Business asset loss versus personal use asset gain. No netting allowed there.
Okay, that makes sense. Now let's look at George's. He had a mix of investment gains and losses, some short-term, some long-term. This should really show that netting process.
George's example is perfect for seeing how investment gains and losses interact. So he had a short-term capital loss of $3,250, and he also had a long-term capital loss of $2,300.
Okay, so total losses of
Very
$5,550.
Correct. $5,550 in total realized capital losses from his investments. But he also had some success. He realized a short-term capital gain of $1,500. So the next step is netting. We combine all these. $5,550 in losses minus the $1,500 gain. That gives George's an overall net capital loss for the year of $4,050.
Right, $5,550 loss, $1,500 gain equal $4,050 net loss.
Exactly. Now, how much of that can he deduct this year against his ordinary income, like his salary?
The $3,000 limit we talked about?
Perfect. So George's deducts $3,000 of that $4,050 net loss against his ordinary income on his current tax return. This directly reduces his taxable income for the year. What about the rest? He had a $4,050 loss, deducted $3,000.
That leaves $1,050.
Yeah, right. And that remaining $1,050 is not lost. It gets carried forward to future tax years. It will retain its character. We'd need to know the specifics of which losses offset the gain to know exactly how much is short-term versus long-term carry forward, but the $1,050 total carries forward. He can use it next year or later years to offset future gains or deduct against ordinary income, again, subject to that $3,000 annual limit.
So wrapping this all up,
Yeah.
what's the big takeaway for you, the listener? Whether you're new to this or just brushing up.
I think the core insight is that really understanding this difference, realize versus recognize, is just, well, critical for smart tax planning and for making informed financial decisions. Whenever you're thinking about selling an asset, whether it's personal stuff or investments, you need to ask, will this gain or loss be recognized? And if so, how will it be treated? Knowing that helps you anticipate your tax liability, maybe time your sale strategically, and just generally be more in control of your financial picture. It stops you from being surprised come tax time.
That definitely raises an important question for everyone listening. How might really grasping these distinctions, realized versus recognized, personal versus investment, short-term versus long-term, actually change how you approach selling things or making investment choices down the road? Something to think about.
Absolutely. And if you do want to go deeper, really master these rules, I definitely recommend checking out those extra resources. FarhatLectures.com has more multiple choice questions, true-false exercises, and practical problems that directly reinforce what we've covered. It's great practice whether you're aiming for the CPA exam, becoming an enrolled agent, or you're an accounting student wanting to solidify this knowledge. Really valuable stuff there.